Hello investors, my name is Ujjwal and today we are beginning a new series called Wealth Culture Flexi Cap Multi-Bagger Ideas, where we will be covering potential multi-baggers of the future basis our own research. As part of this series, we will do detailed analysis of 3 to 4 companies in a month. So do subscribe our channel for regular research updates from our side. The idea is to analyze how companies make money and to judge whether a business model is superior or not. Let's get started. In today's video, we will be covering a fintech company that has changed itself from an old school full service broker to a discount broker. Before we delve deeper into the company, I want to cover a very important framework that is relevant to our discussion today, and that is called value migration. We have made a separate video on this framework, the link for which is available in the description below. The broking industry is going through a phase with more and more consumers preferring discount brokers versus full service brokers. And our fintech company is benefiting hugely because of that shift. So there is value migration happening because of changing consumer preferences. We've seen a lot of demat accounts open over the last 2 years during the COVID period. Most of them are new first-time investors in the 25 to 30 age group from tier 2 and 3 cities who are looking for simple, reliable, cost-effective ways to trade and invest in the stock market. Easy availability of investing knowledge on various digital platforms like Twitter, YouTube, Smallcase, and many others have made it practically very easy for retail investors to know what to buy and sell without having to consult a full-service broker. This is analogous to what happened in the airline industry, where consumers were more than willing to use a low-cost carrier versus a high-cost full-service carrier. What it did is that it enabled a larger group of people to use air transport versus the smaller group of people that were using when only full service carriers were operating. So it has expanded the market significantly, and that is what we are seeing in the brokerage industry as well. We are seeing more and more people opening more and more demat accounts to invest directly. The fintech company that we are discussing today is on the favorable side of value migration, and this is the first check that I would do for the stocks that I am evaluating. I don't want to go against the tide and hence would avoid companies that are not benefiting from changing consumer preferences. In this case, my company is benefiting. So that's the first check. We will talk more about this in the next section, where we will analyze the industry structure and discuss some numbers also. After we've discussed the industry, we will get deeper into the business design itself and evaluate why the business design of our fintech company is superior to the others. Post that, we'll also discuss valuation and try and understand if the company is undervalued or overvalued. To end the video, we'll also try and understand some KPIs that are essential for us to track the company going forward and judge whether the execution is on the right track or not. So let me now reveal the name of the company. It is Angel One Broking. Let us first begin with the overview of the broking industry, and here I have 3 major points to discuss with you. The first point is related to the penetration of demat accounts in our country. The number of demat accounts have more than doubled since March 2019. Cumulative demat accounts stood at 3.6 crores as on March 2019, and this was about 7.7 CR as of end of November 2021. Even after this dramatic rise, we are still only at about 6% penetration. Compare this with China, which is at a penetration level of 13.7%, and US is at a penetration of upwards of 30%. So there's a lot of potential to grow going forward too. From here on, India can potentially double its number of demat accounts to match China in the medium term and USA over the long term. So from industry point of view, we see a lot of growth in the future. Second point is that discount brokers like Zerodha, Angel One, Upstox, 5paisa are leading the way in terms of market share in active clients. Top 5 discount brokers have more than 55% market share of the active client base. Market share in terms of revenue is slightly below at 30%. But this is in accordance with how value migration works. First, the market share and market capitalization starts to rise, followed by sales and profitability. So we will definitely see sales and profitability catching up in the future. Third point is related to how the industry is evolving or expected to evolve going forward. Till very recently, full service brokers like HDFC, Kotak, ICICI were reluctant to change their business design. But they are losing market share aggressively. And hence, in light of the changing market share, they have also started launching discount schemes where their pricing is very similar to the pricing of the discount brokers. Couple of reasons why they won't be very aggressive here and will definitely not be able to beat discount brokers. The first is that if they go very aggressive on this strategy, then what they are essentially doing is that they are killing their own full service broking business, which is obviously highly profitable. So they will see a period of transformation which can extend from 4 to 5 years, where they will transform their full service broking business to a discount broking business, and that period is going to be painful. The market will not be kind on these companies, and in some cases we will see the stock market, the stock price of these companies underperform significantly. So they really need to accept this change in order to be very aggressive on the discount broking side. The second is that most of the clients already have two accounts, one for investing and one for trading. And so they don't have any incentive to now create a third account with any of these full service brokers for the same set of benefits that they're already getting. The third is that these full service brokers will have to now acquire new clients from tier 2 and tier 3 cities. Now the lifetime value to cost of customer acquisition ratio for these clients will be significantly lesser. So the cost to acquire them will be higher, while the revenue that they can generate out of these tier 2, tier 3 clients will not be that high. And hence for them, on a relative basis, where they are having clients that are highly profitable, getting into clients that are very low profitability is also a challenge. It needs to be seen how aggressively they are pursuing this strategy going forward. Having looked at the industry, now let us evaluate the business design of Angel One Broking. Some brief about the company and its recent transformation. Incorporated in 1996, Angel One is a technology-led financial services company. It offers services like discount broking and advisory, margin funding, loans against shares, and distribution of third-party financial products. Over the years, the company has transformed itself from a traditional authorized persons-led, which is branch-led broking, into a direct digital broking business model. Sometime in 2015, the company took a bold decision to disrupt its existing broking business and convert into a fintech platform. It took good 4 to 5 years for this business transformation to take place. Pre-2015, the company had an established network of more than 180 branches across the country and was following a physical client acquisition and onboarding model. Between 2015 to 2019, Angel One started to digitize all its processes and build many digital properties. For example, it launched Arc platform in 2016, a hyper-intelligent investment engine which makes superior investment advisory available to every Indian consumer, which was otherwise available to only the big ticket and HNI investors. It also launched Angel Bee in 2018, a personalized mutual fund recommendation app. It was due to these efforts that in 2019, the company introduced its flat fee plan. Today, it is a completely digital model where 100% of direct clients are onboarded and serviced digitally. It is also using artificial intelligence and machine learning extensively to continuously improve upon its clients' digital experience journey. Very recently, they hired a new CEO who comes from a tech background, and his experience of running digital business will be instrumental in making Angel One a true fintech platform. So they seem to have transformed themselves at the right time and are now positioned favorably to benefit from the changing trend from full service brokers to discount brokers. Also, going forward, they seem to have the right management and talent required to push this to the next stage of growth. Now let us evaluate the revenue models. The company's revenue model can be broken down into two segments. In the traditional plan, we have the B2B business and the B2C business. B2B business is the pre-2015 authorized persons physical network business, where Angel One shares 30% of the brokerage income earned by physical sub-brokers. And the B2C business is the old plan, where the revenue is based on percentage commission of the value traded. The second is the new flat fee model that got introduced in 2019. And here, flat fee of ₹20 is charged on every order, irrespective of the value traded. Over the last couple of quarters, out of the total clients added, about 92% of them are now under the flat fee plan. So majority of the customers are now flat fee customers. Even when it comes to the revenue contribution from direct clients has gradually increased to now being 76% of the total net broking revenue. So as you can see, both by customer type and revenue type, the business has significantly moved towards digital discount broking just in the last 3 years. Now let us look how the company has grown. Angel has now 3.1 million active clients on NSE with 9.7% market share of the active clients. Ranking third after Zerodha and Upstocks, the market share has doubled from 4.9% in Q3 of 20 to 9.7% in the most recent quarter. This can be seen in the average daily turnover as well across equity and commodity segments. If you look at the quarterly average daily turnover charts across various segments, the overall equity market share of Angel One has increased from 5.9% in Q3 of FY20 to almost 20.9% in the most recent quarter. This is majorly led by increase in market share in the F&O segment, which is the futures and options segment, which by the way is the major revenue contributor, and we'll see the revenue breakdown in a minute. Market share in the cash segment or the delivery segment has remained the same, slightly impacted by the margin trading norms implemented by SEBI last year. Angel One has also increased its market share in the commodity segment, and it is now at 36.5% versus 19.1% in Q3 of FY20. Here, we need to note that almost 98% of the average daily turnover comes from the F&O segment. Ability of the company to maintain its market share in the F&O segment is key to good financial performance of the company. The company's revenue can be broken down into three major sections. First is the broking revenue. Second is interest, income and depository revenue. Third is distribution and other revenue streams. Cross-broking revenue via direct and authorized partner network contributes majority of the revenue, which we believe is very sticky and less volatile to market cycles, and we'll discuss this in a short while. Angel One's superior UI and UX and various digital offerings like ARC make the platform even more sticky. Interest income comes from the 18% interest rate that Angel One charges on its client funding book, which has risen at a strong pace while keeping the average client exposure in check. Depository income is revenue charged by Angel One on sell transactions per script on delivery trades. The third is the distribution business, which is very small at this point of time, only at about 2% of the entire revenue. However, the company is coming up with a super app that will have various third-party products like insurance, mutual funds, etc. that could scale up this segment through cross-selling to its existing customer base and can be hugely profitable because there is no additional cost once a customer has been acquired. As can be seen, about 68% of the total revenue is coming from the broking business, another 16% from interest income, and the remaining from distribution and other segments. If we were to give a breakup of the broking revenue, then majority comes from the equity segment. Within equity, F&O contributes majority of the revenue, as we discussed earlier, because the average daily turnover from the F&O segment is also a lot higher than any other segment. So 74% of the revenue, broking revenue, just comes from the F&O segment, and remaining 22% comes from the equity cash segment. Commodity and currency both contribute 3% and 1% respectively, but these are smaller shares of the entire revenue. Here, I want to now compare the traditional revenue model with the current discount broking model and explain why I believe the discount broking model is much superior, and this is core to my investment thesis. In the traditional discount broking model or the full service model, about 70 to 80% of the broking revenue comes from delivery trades, where the revenue is a certain percentage commission of the average daily turnover or the volume of money traded with the broker. The remaining 20 to 25% comes from intraday and F&O trades, where the pricing is mostly flat even with a full service broker. In the case of a market correction or bear market situation, the average daily turnover on the delivery side reduces significantly, and to that extent the broking revenue also gets affected. While on the intraday and the F&O side, the effect is not as much because full-time traders trade even during down cycles, and anyway the pricing is flat there. So there is significant impact on the revenue for a full service broker because of its cyclical model, as it is directly linked to a bull market situation or a bear market situation. Contrast this with the discount broking model, where the revenue from the delivery trade is almost nil. Majority of the revenue comes from intraday and F&O, where again the pricing is flat fee based. So the impact of market correction is modest, as the number of trades in intraday and F&O expected to be flat as full-time traders trade even during down market cycles. Let us now look at some quarterly numbers to verify this claim. In the cash segment, the average daily turnover peaked in Q4 of FY21 and has reduced since then. Despite the fall in average daily turnover, we saw number of trades kept going up even in the most recent quarter when the overall market had started to correct. In the F&O segment, it has been a one-way journey where both average daily turnover and number of trades have been rising continuously. This can also be seen in the monthly update for the month of February. Overall number of order is still on the rise along with the average daily turnover in the F&O segment. The average daily turnover in the cash segment has reduced as expected during a phase of market correction. So these are the reasons why I believe that a discount broking model is much superior model to the traditional full service model. Let's now quickly look at the financial performance of the company and compare it with peers. I'm going to look at the quarterly numbers because the business has changed significantly over the last 10 to 12 quarters. So it makes sense to evaluate just the quarterly numbers. Revenue has increased from 200 odd crores per quarter to about 600 odd crores in the very recent quarter. Along with that, profitability has also increased from 12% to 40% in the most recent quarter. So this business design is definitely profitable. And we can see that revenue is coming at a higher profit margin, and the business is able to acquire profitable customers with lesser cost of acquisition. Now let us quickly compare it with ICICI and 5paisa, two of the other listed players, and then we will look at the valuation in that context. As can be seen here, Angel One has posted a 3-year sales CAGR of 19% and profit CAGR of 40%. 5paisa has seen the best growth because of its fairly low base, while ICICI has posted the lowest 3-year sales and profit growth between the three players. From returns point of view, ICICI has the best profitability, and this shows that ICICI has the most profitable customers among the three here. Returns for 5paisa are the worst between three of them. That being said, Angel One has the right combination of growth and profitability going forward. Having done the comparative valuation, what are some of the positive surprises that we can see going forward? The first is on the distribution revenue side, which is mere 2% today. ICICI Securities, on the other hand, has distribution revenue going up to 25% of the revenue contribution. So there is enough scope for the revenue from the distribution business to scale up from here onwards. And I believe that the super app that the company is planning to launch is going to be a huge success in terms of the distribution business, because then Angel One will be able to cross-sell many other financial products to the same set of customers without incurring any additional cost. And hence, all of that distribution business will come to the bottom line at very high profit margins. This will lead to significant expansion in the margin profile of the company. Second is that the average revenue per customer also needs to go up from here on. As we can see that the average revenue per customer for discount brokers is fairly lesser than the other traditional brokers that have been in the market for long. So going forward, we can definitely expect the average revenue per customer to inch upwards, and this will also start coming at lower customer acquisition cost. Currently, most of the customer acquisition is being directed through performance marketing, and hopefully we will see more and more customers come to us through organic marketing, and hence the ARPU, the average revenue per customer, is expected to go up, and the cost of customer acquisition is expected to come down, which will lead to further increase in profitability for Angel One. Now let's look at the valuation. Currently the company is trading at trailing 12-month PE of about 20x, which is higher than the PE of ICICI Securities, which is trading at 14.3x. This definitely tells us that the market has started giving Angel One premium valuation over ICICI Securities in expectation of better performance in the future. But given the future growth potential and the resilience of the business design, then we might see the stock re-rate to a PE of more than 25. and the EPS growth will definitely happen over the next 4 to 5 years. So we are in a situation where we are expecting both the price to earnings ratio and the EPS to grow going forward. Now this is my view. Please do your own research before investing. This is not an investment advice. Now what are the risks to this investment thesis? The first risk is that the revenue and profitability may actually dip because of a prolonged bear market situation, which means that the business model is not as resilient as we are thinking it to be. This leads to reduction in PE ratio, and simultaneously we might see a phase where EPS growth is at a standstill or might come down for a couple of quarters also because of the prolonged bear market situation. So we might get trapped in the stock until the next stock market bull run, like any other traditional broking business.